Hello and welcome back to The Note. This is the week when we start to hear from Janet Yellen in her own right, because we have the Humphrey Hawkins testimony to Congress to look forward to. Now, she's had a very clear path set for her by her predecessor, Ben Bernanke, but there's already speculation that she might need to deviate it, particularly following the non-farm payrolls data for January, which took many people by surprise. With me now to discuss what we might be about to find out from the Fed is our US markets editor, Mike Mackenzie. Mike, thanks for joining me today. Could I start with taking a look at those non-farm payroll data? We obviously saw a continued quite impressive improvement in the unemployment rate. It's now almost at the threshold where Ben Bernanke said they might consider raising rates, but the main payroll data was quite disappointing. What do you think are the main takeaways from that report?
Well, I think the market sort of realizes that the participation rates makes looking at the unemployment, the actual level of unemployment, quite difficult to gauge where the Fed's going to go. I think what's really interesting now is that we are sort of seeing some concern flickering about disinflationary forces here in the US. And I think that's where Janet Yellen is going to move towards. The market reaction post-payrolls has been somewhat surprising that we saw equities rally. But we also saw bond yields, particularly in the intermediate part of the curve, led by the 5-year drop. And that tells us that the market is increasingly pricing out future rate hike expectations. So it seems for now that the Fed's message of that tapering is not tightening is actually working a lot better. And I suspect when you look at some key measures of inflation expectations, such as the Fed's own 5-year measure, that's been dropping recently. It's actually down to its lowest level since last July. So I think Yellen will probably look to move away from emphasizing the unemployment rate, more towards saying to the market, look, we're way below our inflation target of 2%, and we need to get back to 2% before we even think about raising rates. So that kind of creates a sort of a Goldilocks scenario, I think, for the equity market going in the next few weeks, because they can kind of say, well, rates aren't going to be raised, and for now many people in the equity market still suspect the data that we've seen lately has been affected by the harsh winter here in the US.
Okay, so to some extent the taper is going to happen. We are going to continue to see 10 billion less in bond purchases at each FOMC meeting as we go through the year. That's what people are predicting. But we're going to get more dovish forward guidance from Yellen sometime soon. That you're saying is the base case that people are working from now.
Well, she has to be careful because she has a reputation for being dovish. However, now as the Fed chair, she's got to be seen taking a more middle of the road stance and sort of come across as more objective, because she's there to sort of pull together the strands of diverse opinion that across the Fed board, and basically produce come to a consensus view. I think, however, she will emphasize the inflation part, because I think that's what's beginning to trouble some people in the market and indeed investors generally.
Okay, now one final question I'd like to ask you about is the equities market. Last year was that very unusual year when the S&P went up more or less in a straight line, barely even any correction of 5%, let alone 10%. Yes. It was a very popular call as the year turned that we not only needed but wanted a 10% correction. It's looking, however, the market's been given plenty of excuses to sell off, and it's not really taking them. Why do you think that the equities are taking this in as positive a way as they are?
Well, we have had somewhat of a correction. We've seen just over 100 stocks within the S&P 500 experience a 10% correction already this year. So there are buying opportunities emerging. And I think it's going to be a bit of a choppy market for the next few weeks until we get more clarity from the data. I think one of the concerns is that whenever you hear people saying, oh, we want a 10% correction, be careful what you wish for. You're either going to get a 5% correction in the broad S&P because everybody's going to jump in like they did last year and say, I've got to get in now. Or it could go a lot further. And given the amount of leverage and the record levels of margin that we see in the US market, and just the sort of popularity and the dominance of ETF flows in particular, I'm not so sure if we do indeed see the S&P retreat a full 10%, whether it just stops there. It could very easily go a lot further.
Okay, so compared to the last 3 years of the great bull market of the 90s, there were 7 separate 10% corrections and nothing that got much beyond 20%. The argument now, with far more leverage, with hedge funds being more dominant in the system, is that we're not going to see that pattern again. If
Maybe
we do
not.
get a correction, it'll be a real one.
Yes, and the key to watch will be volatility. What QE has done so well is suppress volatility. So earlier, last Monday, we actually saw the VIX finally rise above 20, very briefly. But 20 in the past has always marked the threshold. It's been the average for the VIX for the last 30 years, and the VIX has a standard deviation of 6. So if you break 20, you're at least going to go to 26 and probably higher. And so if you're going to get a bigger correction than just 10%, VIX will tell you. If you see that move in VIX above 20 and it starts to accelerate, then you know that there's a bigger correction coming.
Okay, Mike, thank you very much indeed. I think the message is clear. We need to watch what Janet Yellen says with very, very closely, with very great attention. For the time being, though, the market bet is that we have not something that Janet Yellen could be appearing as some form of a new Goldilocks. Things are not so hot that the Fed needs to really put on the brakes, but not so cold that we need be worried either.